Let's continue the conversation. Bring in Fidelity Investments Director of Global Macro, Jurrien Timmer. Jurrien, happy Friday. Great to see you.
Good morning.
You raised the point in your note, the question of whether or not we're venturing into a new cyclical bull market or if this is simply a bear market rally that, in your words, is now at an overbought extreme. What do you think?
Well, I can tell you that we don't know the answer, unfortunately. And the problem with technical analysis is that unless you add some context or make some assumptions, a lot of indicators are kind of inconclusive. So I can tell you that we've had a good breadth thrust, as they call it. We have had very good breadth, percentage of stocks above their 50-day. I think it was at 92% a few days ago. We've retraced half of the rally, as Mike said. And bear market rallies really generally do not retrace more than half. So if you were a bear and you thought this was a bear market rally and you look at the overbought technical condition, you look at the return to the 200-day moving average, you look at a 50% retracement, this is a pretty, compelling opportunity set if you are leaning in that direction. Often the test will come what happens after this overbought condition, and we are overbought. You look at the stochastics, the breadth numbers, we're all short-term overbought. And so how the market behaves from here, I think, will be very important. And I liken this particular moment to kind of the June 2020 moment, which, of course, was the first momentum peak in obviously a very strong bull market. And I'm not saying this is going to be the same way, but it took some time to digest that, and then the market kind of resumed its rally. So we are very much at a fork in the road. I do think that at the bottom, at down 25%, the market discounted a lot of bad news, right? And so if investors were preparing or bracing for a recession and that recession doesn't come, and so far I don't think it has, then of course the market got way too oversold at down 25%. Even if a recession does come, but it's kind of a technical one, not associated with mass layoffs and things like that, at 25% down, discounting what would typically be a 35% bear market, it priced in 70% of a recession outcome. So that's kind of how I think of it. So I think the bottom is probably in, but financial conditions are easing again, even though the Fed still has 100 basis points of rate hikes ahead. So if I were at the Fed, I would imagine I'm a little bit perturbed by that. I would want to jawbone the markets back into, hey, we're not done yet, so don't declare victory too soon.
So David mentioned Jackson Hole. Is that the place to do it?
Oh, sorry.
Jurrien, I said David mentioned Jackson Hole next week. Yeah. Is that the place where you would expect Powell to start to temper some of those hopes for the bulls?
I think so. I mean, the Fed has gotten to 2.5. It's presumably is going to 3.5. Credit spreads are narrowing. Bond yields are down, at least until a few days ago, and equities are up. And so it could be Jackson Hole by Chair Powell, of course. It could be other Fed officials. But if financial conditions ease too soon, even though the inflation rate apparently has peaked on a rate of change basis, I think the Fed would want to make sure that the market doesn't get too complacent here. And remember, the CPI, we're in August now, the CPI is already up 6.8% year to date, right? So even if inflation rolls over, in a more significant way than it even has during the last month, we're going to end up with 7-8% inflation this year. And I think the risk for the markets is that if you look at the tips market thinks we're going to be back at 2.5 in 5 years, which, wouldn't that be great? That means we're back in Goldilocks. But let's say it only goes down to 4% or 5%. And what happens if we get a recession next? What would the Fed be able to do to combat that when inflation is still sticky? So I think the Fed will want to err on the side of sounding more hawkish than perhaps it even wants to be, to make sure they get to that 3.5% terminal rate.